Hello, welcome back to Gold Off the Charts. In this financial market full of uncertainties, gambling, and fog, we don't focus on the surface level excitement. We only look at the deeper principles. With a bit of financial insight every day, we help you see farther, walk more steadily, and stay longer on the road to wealth creation. Before we dive into today's video, I'd like you to take 3 deep breaths with me to calm your nerves. Why? Because we just went through a crazy dip in financial history, one that will be recorded in the books. If you were watching the gold market like I was, your feelings couldn't just be described as thrilling. It was truly an ultimate test of heart, strength, and human vulnerability. The gold market experienced a textbook cliff dive. Gold prices plummeted from the sky-high $5,600 per ounce to a straight drop like a kite with its string cut, crashing all the way down to $5,100. Friends, listen carefully. This was a massive shock of $500. If you were using high leverage and chasing long positions at the top, you may have experienced the feeling of wealth disappearing to zero in an instant. Silver wasn't idle either. This mad dog of the precious metals world shot up to a historic high of $121, only to reverse and plummet over 12%, now struggling around $110. I know, you must be anxious right now. Is this the top? Has this 2-year bull market come to an end? Should I cut my losses and run? Or should I take the risk and try to buy the dip for a comeback? Actually, if you watched my video yesterday, you shouldn't be this panicked. I repeatedly emphasized yesterday that, with gold experiencing its unprecedented 9 consecutive days of gains, market sentiment had already reached an extreme, like a bowstring pulled taut. A pullback could happen at any moment. So, we don't need to be too shocked or fall into blind panic over last night's high-altitude bungee jump. Today, I'll use this in-depth analysis to completely reveal the truth behind this massive drop. We'll talk about why one simple sentence from President Trump could turn global gold prices around, and more importantly, I'll leave you with a highly valuable future reference. When we face the same crossroads again in the future, what historical patterns should we rely on to judge whether gold's rally has truly run out of steam? This content is packed with useful information, so please listen patiently, because it's not just about gold, it's about how you can build your own foundational logic for financial decision-making. Let's dive in. First, let's quickly recap the trigger for this crash. The logic is simple. It's 4 words. Extreme turns into the opposite. When gold surged from over $4,000 to $5,600 in a short period of time, the profits in the market became as thick as a wall. At this point, the bulls were like a group of people standing on a thin high wire, all staring at the exit. The slightest movement would send everyone scrambling to secure their profits, triggering a stampede effect, which was the hidden force behind last night's crash. And last night, geopolitically, there was a very timely news trigger, which is the obvious factor behind the drop. The market suddenly went wild with news that Trump had ordered the withdrawal of troops from Iran. Think about it before. Gold's rally was largely driven by the looming risks and fears of conflict in the Middle East. Once the news of troop withdrawal came out, the fear factor powering gold's rise suddenly ran out of fuel, and it lost altitude instantly. Once people felt the war isn't happening, the heavy risk premium on gold quickly evaporated like a bubble. But I know you're more concerned about the next question. After this sharp decline, will gold quickly recover? Or has the price already topped out? We need to break this down on 2 levels. The first level, look at gold's market absorption power. After gold dropped to around $5,102 during the New York session last night, something very interesting happened. A strong V-shaped rebound. Gold didn't stay flat at the lows, but quickly bounced back to around $5,400. Although today's Asia-Pacific session saw some giant fluctuations that shook investor confidence, leading some to sell off, causing gold to weaken again, it hasn't experienced a second collapse. Remember the important detail I've shared with you? If a market drops significantly after a high-volume sell-off and then closes with a huge bearish candlestick, followed by more high-volume declines with no reversal, it's a strong signal that a temporary top has likely been reached. However, if we continue to see funds supporting gold around the $5,000 to $5,100 range, or if the U.S. session can help gold recover again tonight, it indicates that this drop is merely a short-term risk release, and there are still large funds waiting to buy at lower prices. The second level, does the underlying thinking change? The main driver of gold's current historic rally is none other than Trump. While the market was eagerly anticipating the Federal Reserve's rate decision early Thursday morning, as expected, Powell stuck to his usual data-dependent rhetoric. Under Trump's superstar influence, the Fed was almost ignored by the market. The current consensus in the market is that Trump's extreme operations around the world, the tariff stick, the Greenland acquisition proposal, the Venezuela situation, and the naval carriers in the Indian Ocean have led to geopolitical tensions, a trend towards de-dollarization, and global sales of U.S. bonds. Have these driving forces for gold and silver markets disappeared? Clearly no. The troop withdrawal might be a temporary tactical adjustment, but the backdrop of global chaos hasn't changed. Therefore, my personal judgment is that while this series of event-driven factors has led to gold prices rising too fast and creating a bubble, this current drop is more of a detox, clearing out short-term overheated sentiment so the bull market can continue further. All right, let's now get to the main event of today's video. We're not predicting a specific price point here because in a once-in-a-decade crazy market like this, any attempt to forecast a specific number is nothing but playing games. What we want to discuss is, when gold's rally truly reaches the point of running out of fuel, what historical patterns will give us signs? I've summarized 5 key reminders for you. These are the reference notes I've compiled from half a century of bull and bear cycles. When you see these signs appear together in the future, no matter what the price of gold is, remember to get out. The first reminder: the trend of gold is never determined by interest rate cuts themselves, but by the reversal of real interest rates. In all the classic finance textbooks, or by those second-tier financial advisors, you'll often hear, "Gold is inversely related to interest rates. Cutting rates is good for gold. Raising rates is bad for gold." This is only half true. Gold, being a non-yielding asset, doesn't generate any interest or dividends. The only cost of holding gold is the real return you could have gotten if you invested your money in other interest-bearing assets, such as U.S. Treasuries or term deposits. How do you calculate this return? It's simple. Real interest rate equals nominal interest rate, inflation expectations. Looking back at history, the 2 most significant gold bull markets ended with a trend reversal in real interest rates. The first one was in the 1970s. At that time, the Bretton Woods system collapsed, the U.S. dollar decoupled from gold, and the oil crisis led to global inflation. Real U.S. interest rates were negative for a long time, meaning that the more you kept money in the bank, the less it was worth. That's why gold soared from $35 per ounce. How did this rally end? It ended when the legendary Chairman Volcker took control of the Fed, pushing interest rates to double digits, even reaching 20% at one point, bringing real interest rates back into positive territory once people realized that holding U.S. dollars could offer stable returns and outpace inflation. The thinking of gold as a safe haven completely collapsed. The second round was the bull market from 2001 to 2011. Even though nominal interest rates weren't that high, when the market started to fully expect the end of QE quantitative easing, real interest rates began to recover and gold prices immediately peaked, followed by a decade-long bear market. So when people are constantly debating when will rates be cut, as long as this issue is still up for discussion, gold still has room to rise. But when one day rate cuts become the market consensus and people begin to think that rate cuts are taken for granted and not worth discussing, that's when we need to be alert to real interest rates turning upward, signaling the end of the bull market. The second reminder: demand won't disappear, but a slowdown in marginal increases is an early warning sign. The core difference between this gold bull market and the one in 2011 is the structure of demand. Back then, individual investors and ETFs drove the market, but now central banks around the world have become the most consistent structural net buyers. Many people think if central banks keep buying, gold won't fall. But I want to tell you that historical patterns show the end of a bull market never comes because demand completely disappears, but because the marginal increase in demand has peaked. What does that mean? It's like driving a car. You keep stepping on the accelerator and the speed increases. This is the acceleration phase. But when you floor the pedal and the speed no longer increases, maintaining 150 kilometers per hour, it's still fast, but the acceleration is gone. When gold prices surged to their peak in 2011, global gold ETF holdings were still at historical highs and even slowly increasing. But the problem was the rate of increase had slowed significantly. That's the deceleration of marginal forces. Now, even though central banks are still buying, if the scale of buying shifts from continuously accelerating to stabilizing at a high level or even declining marginally, it means the strongest driving force has been exhausted. This won't cause a price crash immediately, but it will push the bull market into a slow consumption phase, paving the way for a future reversal. The third reminder: When gold is only supported by the safe haven logic, the market becomes very dangerous. A healthy, sustainable gold bull market often has clear macro resonance characteristics. Simply put, when gold goes up, oil goes up, copper goes up, and agricultural commodities go up. This indicates that money is increasing globally and inflation expectations are rising. Such a market is solid and stable. But if one day you find that oil, copper, and the CRB commodity index are all weakening while only gold continues to rise, propped up by geopolitical conflicts and fear-driven sentiment, that's when the alarm bells should go off. The safe haven sentiment is only temporary, and people eventually become numb to it. In 2011, this signal appeared when the global economy was slowly recovering, but commodities as a whole were weakening, while gold surged in the last wave of trust crisis. This kind of single logical market is very fragile. Once geopolitical tensions ease, or people get bored of the war news, gold will experience a correction that could be far more dramatic than you think. The fourth reminder: the return of the inverse correlation between the US dollar and gold is an early warning. We often hear that when the dollar is strong, gold is weak. But in the later stages of a gold bull market, this inverse relationship often temporarily breaks down. We see the dollar rise and gold rise simultaneously. This is usually due to extreme global panic, where people want only US dollar cash and physical gold. The market often interprets this phenomenon as gold structurally strengthening, thinking it has broken free from the dollar's influence. But based on historical patterns, what we really need to be wary of is not the failure of the inverse correlation, but the return and strengthening of this correlation. When the dollar enters a sustained uptrend, and gold stops ignoring the pressure and starts to weaken alongside the dollar, it signifies that the market's pricing logic is returning to normal, and the bull market is reaching its end. Last night, we actually saw the dollar index rebound, while gold showed a clear negative feedback, and this is a detail we need to watch closely in the next few weeks. The fifth reminder: changes in the market participant structure often lead the price signals. Gold prices are driven by market participants, so who is buying matters more than how much they're buying. Long-term funds, such as central banks and sovereign wealth funds, tend to drive stable, low-volatility markets. In contrast, short-term trading funds, such as hedge funds and high-leverage investors, tend to cause frequent pullbacks and big swings that make you question your life choices. If you notice that while prices are still hitting new highs, the non-commercial net long positions in the futures market aren't increasing in sync, or even start declining, this is called a divergence in positions, or if market volatility sharply rises and any slight bearish news triggers a rapid sell-off, it essentially means the smart money and long-term capital are quietly exiting the market, leaving the short-term speculators holding the ball. When the market becomes increasingly reliant on high turnover and high leverage, a collapse can happen in an instant. Lastly, after all these complicated market patterns, let me give you some practical, even life-saving operational advice. 1. Go with the trend. Don't rely on intuition to pick tops. Right now, the market is like a startled bull. Even though the drop was fierce, the broader trend hasn't been completely broken. Don't think, it's risen too much, it must go down now, and try to catch a falling knife. Historic markets usually exceed everyone's expectations. If you try to pick the top, you'll likely get shaken out and watch it make new highs. 2. Strictly differentiate between long-term and short-term positions. I always advise my followers to split their capital into two parts. The first part should be long positions held from low levels or physical gold that you've purchased. For this part, I recommend keeping it set in stone. In a bull market, the worst thing you can do with long-term positions is constantly mess with them, only to end up with all your buy and sell decisions wrong, ultimately wasting effort. The second part of your funds can be used for short-term trades to take advantage of major moves. When gold drops to the $5,100 support level, it's a good chance to experiment with some short-term trading, which will lower your overall cost basis and maximize profits. 3. Look for opportunities in pullbacks, don't panic, and sell. If you're on the sidelines or looking to add positions, this $500 earthquake isn't something to panic over. Instead, it's an opportunity God is giving you the chance to get in at a lower price. The $5,000 to $5,100 range is an important psychological and technical support point. As long as market absorption is still there, any adjustment is just setting up for a better rally. 4. Watch for buying signals from Asia. The power center for gold is indeed shifting eastward. The Shanghai Gold Exchange's premium over London and New York is a critical indicator. As long as physical demand from Asia continues to surge, Western sell-offs will just be temporary noise. Looking back at the past half-century, no gold bull market has ended due to a single event. All trend reversals are the result of the combined resonance of real interest rates, demand structure, and market sentiment. In this video, I'm not going to give you a specific time frame, because predicting exact timings is a task for the gods. What I want to leave you with is a verifiable observation framework. The signals that were once ignored will become key in avoiding risk and protecting your wealth in the future. The current sharp drop, I believe, is more of a detox to clean out weak speculative capital and excessive leverage. If you are a medium to long-term holder, I recommend maintaining your position and don't let the market's volatility shake you out. Finally, as I always remind everyone, all the analysis above is based on my deep observations of the current market information, news reports, and personal thoughts. The purpose is to help you clear your thoughts and see the truth behind the fog. This does not constitute any direct investment advice. The market has risks, and trading requires caution. Each person's risk tolerance is different, so be sure to make independent decisions based on your trading preferences. The market carries risks, and trading requires caution. Everyone has a different risk tolerance, so be sure to make independent decisions based on your own trading preferences. Investing is a journey of self-discipline. Others' opinions can only serve as references, but your own judgment is key. That's all for today's share. If you found these insights helpful, or if they helped you make sense of this complex market logic, feel free to leave a comment below and let me know your thoughts. Also, don't forget to like and subscribe to Gold Off the Charts. And share the video with more friends interested in finance. In this crazy, absurd, yet opportunity-filled time, I'll always be with you. See you in the next video!